I cringe every time I hear people say, when the stock market is down, you gotta buy the dip. Stocks are on sale, so you gotta buy the dip. No, you don't have to buy the dip, and I'll show you why it's bad advice for not only individual stock investors, but index fund investors as well. Buying the dip kind of makes sense on the surface from a psychological standpoint. All you're trying to do is buy an investment when it declines in price so that you can get it for a cheaper price than it was in the past, in hopes that it'll rise back to its original level. Unfortunately, the stock market isn't the grocery store. If a bag of chips is normally $4 per bag, and it goes on sale for $3, then buying that dip, of course, makes sense. I'm sure there's a chip dip joke there somewhere, but my brain just cannot think of one right now. The human brain is constantly trying to detect patterns between what we already know to be true, buying something on sale at the grocery store, with things that might be a little more complicated, like buying the dip in the stock market, to come to a closely related conclusion. But this concept in the stock market isn't as cut and dry as something like a sale at a grocery store. Saying to buy the dip gives off this foregone conclusion that any time the price of a stock decreases, you should blindly buy more of it because the price is lower today than it was a week, month, or a year ago. Just because a stock is down 80% doesn't mean that it's automatically on sale. All it means is that the price is 80% lower than it was back in October of 2020 at the all-time high. For it to be on sale, the stock price would have had to have been valued correctly to begin with. So was it? It's normal for a stock to fluctuate up and down, but if it drops by a large amount, like 80%, and the financials didn't really change by an amount to warrant that drastic drop in price, then it must have been wildly overvalued to begin with. In the case of individual stock investors, reevaluating your holdings every month or quarter is the best thing to do to decide with any level of intelligence whether or not you should quote-unquote buy the dip. Another problem is that not many people have even defined for themselves what an actual dip is in terms of percentage amounts and even time periods. Is it a 1%, 5%, 15%, 40% drop? If it keeps dropping, do you continue to buy the dip? Does that dip need to happen within 1 day, 2 weeks, 1 month, or 2 months? At what point do you stop buying the dip? Because if you liked the stock at $500 per share, then surely you like it even more at $98 per share, right? And if you liked your S&P 500 ETF at $437 per share, then surely you like it at $380 per share. Having certain investing rules put in place for yourself is a good way to mitigate risk and avoid catching a falling knife if that stock is tanking and most likely never getting back to those all-time highs. We'll cover a better investing strategy later in the video, so hang tight. I don't want to totally beat up on stock pickers though, because my fellow index fund investing friends are just as guilty, if not more guilty, of that buy the dip mentality, and it's not good advice for them either. Traditional index fund investors aren't really evaluating the price of an index fund to decide whether or not it's fairly priced, which is fine because they're generally investing for very long periods of time. By nature, an index fund holds hundreds, if not thousands, of stocks, so it's basically impossible to properly analyze like you would an individual stock. Technically, you can compare the current price per share to the traditional index funds or ETF index funds and net asset value to figure out if it's trading at a premium or discount, but they're usually close enough to where it's not an issue at all. Because of this, us index fund investors are pretty lazy people because we just blindly buy whenever. It makes it easier to convince ourselves to buy the dip when the price is lower than it has been in the recent past. No matter which type of investor you are, all buying the dip is another form of timing the market because you're sitting on the sideline with cash trying to time when to actually deploy the money. I'll show you how unreliable timing the market is in just a minute. Do my dog Molly a huge favor and hit that thumbs up button. Just because. Let me be clear, because I can feel the Cheeto-fingered viewers typing a response about how they've timed the market perfectly before. Yes, it's possible to time the market once, twice, even 3 times, but it's not very probable that you'll be able to continue to successfully do it over a long period of time. And if you've been successful up until this point, put that ego in that bag and run away as quickly as you can because you've already won the game. All you end up doing is sitting there with a bunch of cash on the sideline, waiting for the market to hopefully dip so that you can deploy just a little bit of it. Because let's be honest, no buy the dipper is really going to deploy all of that money into the market if it drops 12%. I know, because I used to be one of those people. We always think that it can drop just a little bit more, so if we leave some extra cash to buy the next dip, then we'll be in an even better position. When it doesn't come, you're stuck holding the bag while the market continues to go up and up and up. Then, when the next dip happens, it's at an even higher price than before, so you end up paying a higher price for that next dip. Let's say that you can be successful at timing the bottom of the market every single time. To do that properly, you have to be staring at stock screens all day, ready to click that buy button at the perfect time. Who in the world really wants to spend their time doing this? The most valuable thing you have, time, is being spent trying to time the market. Instead of trying to buy the dip, just using a simple dollar cost average investing method is the best solution. But at the same time, every month, no matter what the market is doing. Yes, sometimes you'll overpay and sometimes you'll underpay, but you'll end up with the market average, which is shown to be successful over time. Michael Batnick ran a scenario on his blog to find out what happens when you buy the dip versus dollar cost average into the market to find out what the results would be. From 1990 through 2020, for the dollar cost averaging side, he contributed $4.42 every trading day. For the buy the dip side, he contributed $1 every trading day and an additional $100 every day where the S&P 500 dropped more than 2%. Both sides contributed $33,598 each, but the buy the dip person sat on extra cash and invested it when the market was quote-unquote on sale. The buy the dipper ended up with a portfolio worth $149,913, while the dollar cost average person ended with a portfolio worth $176,732. The buy the dipper most likely spent way more hours tracking the market, while the dollar cost averaging person was out there living his or her life, not getting caught up in why the stock market was up or down every single day. Now you might be thinking to yourself, well, what if you bought the dip when it dropped by more than 2%? Because in my eyes, a dip is more than 2%. 2%? That's not enough. I would only buy if it dropped by 10% or more. Nick Majuli ran the numbers on that for us. At a 10% dip, the buy the dipper outperformed dollar cost averaging 26% of the time. Buying at a 20% dip outperformed dollar cost averaging 26% of the time. Buying at a 30% dip outperformed dollar cost averaging 27% of the time. Let's go even further. Buying at a 40% dip outperformed dollar cost averaging 33% of the time. And finally, buying at a 50% dip outperformed dollar cost averaging 38% of the time. 38% of the time might sound good, but if we flip it around and say that if you dollar cost average, then there's a 62% chance that you will outperform buying the dip, then how would you invest your money? It goes back to what I said at the very beginning. Is it possible to time the market and come out ahead by buying the dip? Yes, of course it is. Is it probable or likely that it will actually work? No, not at all. What it comes down to is that you're just sitting on the sideline with way too much cash for way too long waiting for the next dip. Just like the older and wiser investors always say, time in the market is better than timing the market. We also have to be honest with ourselves in the fact that the odds of you buying every time when the market hits its lowest point is nearly impossible to do. To your left, check out my top 5 Vanguard ETFs to dollar cost average into. Make sure to hit that thumbs up button before you go and check out the description for a lot more goodies and free stuff. I'll see you in the next one, friends. Done.